Hello, Accounting 101 students. In this video, we are going to go over how to compute your cost of goods sold for a company that uses a periodic system. And that basically means that this company does not have a detailed inventory system to keep track of their inventory that they have on hand, their purchases and their returns, and how much they pay for freight and how much of their discounts they were able to take advantage of. So for the periodic system, at the end of the accounting period, a company needs to count up their inventory and do a calculation for your cost of goods sold. So we're going to start off with our calculation for cost of goods sold. And our calculation for cost of goods sold is going to start off with the beginning inventory. So one period's beginning inventory is the previous period's ending inventory. So you're going to start off with your beginning inventory, and then you're going to add the net purchases. So net purchases, you might need to do a little bit of a sub-formula here. Okay, so your net purchases is determined by taking your purchases during the period minus your purchase returns minus your purchase discounts. So that's how you'll get to your net purchases. The other thing that you're going to add is freight in. And this will give you your cost of goods purchased. So during your accounting period, you need to go ahead and take into account your cost of goods that are purchased. And once you know your cost of goods that are purchased during the period, you're going to add that to your beginning inventory, and that's going to give you your cost of goods available for sale. So that is all of the inventory that you have available at your location. So out of all of the inventory that you have available for sale, you're actually going to be selling off some of that inventory. So you're going to need to consider that as part of your cost of goods sold. But because you don't really know how much of your inventory has sold, you don't have a system to keep track, you're going to count your ending inventory at the end of the accounting period. So you're going to subtract out your ending inventory, and that's going to be determined by the physical inventory count. So maybe on the last day of the year or the last day of the month, a lot of the individuals that work at a store location are going to come together and they're going to count up that ending inventory. So if you have the inventory available for sale, you don't have it anymore, that means that it must have been sold. So the difference is going to end up in your cost of goods sold. All right. So using the information in this problem, we're going to first determine the cost of goods purchased. So determining the cost of goods purchased, we're going to need to take our purchases during the period. So that will be $165,130. From there, we're going to subtract out our purchase returns and allowances. In this example, it is $49.60. Then we're going to be subtracting out our purchase discounts. And then we're going to add the freight in. And the freight in represents the amount that our company spent in order to acquire the inventory. So this is one of the costs that needs to be included as part of our cost of goods sold. The freight in is different from the freight out. The freight out is going to be from the seller's side if they needed to pay a third-party freight carrier to transport that inventory when sold. And according to our textbook, this is going to be considered a selling expense as part of the operating expenses section of our multi-step income statement. So that's how we're going to get our cost of goods purchased. The next part of the problem is our cost of goods sold. So for our cost of goods sold, we're going to determine this by taking our beginning inventory in our problem, that is $32,980 plus our cost of goods purchased. So we have just determined this as $162,060. So that will give us our cost of goods available for sale. From there, we see that in this problem, they have counted up the ending inventory. So we're going to be using that ending inventory. And we're going to subtract that out in order to get to our cost of goods sold. So now you'll want to go ahead and take out your calculator and do the math to make sure that this equals your cost of goods sold. All right, so once you've checked that this equals your cost of goods sold, then you will be done with this problem. So thank you for taking the time for watching this short video. Although in a perpetual system, you also will be determining the ending inventory by doing a physical inventory count, the purpose is different between a periodic system versus a perpetual system. In a periodic system, we are required to do this ending inventory count in order to calculate your cost of goods sold. Under a perpetual system, your system will already be calculating the cost of goods sold through each transaction that's being recorded, but you want to make sure that the inventory that you think you have on hand actually represents what you physically have on hand. All right, so please take a look at this information in our textbook. Thank you for taking the time to watch this video.